Share repurchases. A share repurchase is where a company buys back its own shares. The shares that are bought back are called treasury shares or treasury stock. The transaction is called a treasury stock transaction. Treasury shares are not considered for dividends, they are not considered for voting, and they are not considered when computing earnings per share. When a treasury stock operation is conducted, the cash of a company comes down because the company is using its money to buy back shares. This is where a company uses its own money. Later we might also consider examples where a company is borrowing to buy back shares. But in any case, cash comes down and equity comes down. We now consider the different ways in which a company can buy back shares. One method is where a company buys back shares in the open market. This gives the company flexibility because it can time the buyback. A company would buy back its own shares when it perceives the shares to be underpriced. So this method typically gives us the best cost, or it gives the company the best cost because it will buy back shares when the price is relatively low. However, this might take time because if a company shares are currently overpriced, then obviously the company will wait for the price to come down. The next method is a fixed price tender offer. This can be accomplished quickly, but usually the company has to offer a premium. If a share is currently trading for $30, then the company might make a fixed price tender offer to buy back the shares for $32. This is called the fixed price tender offer. If a company wants to buy back shares worth 5 million and investors want to sell shares to the company, let's say that investors come back with 10 million worth of shares, then the company will have to buy back on a pro rata basis. That means that for every investor who is willing to sell 10 shares to the company will only buy 5 shares from him. Next, we talk about a Dutch auction. This is a tender offer with a range of acceptable prices. For example, if shares trade at $50, a company could offer to buy back 2 million shares in the 51 to 53 range. This can be accomplished quickly and usually at a price that is lower than a fixed price tender offer. Let's say that a company initiates this Dutch auction and we have shareholders. 1 million shareholders are willing to sell their shares for 51. Another 1 million are willing to sell their shares for 52, and 1 million are willing to sell their shares for 53. What the company will do in this situation is buy back shares for 52 because at a price of 52 it is able to buy back the 2 million shares. It has to offer a single price. It would not be fair for a company to buy back for 51 from this group of million and 52 from this group of 1 million. So the company actually pays the lowest possible price at which it will cover all 2 million. By following this strategy, a company might actually have a lower cost compared to a fixed price tender offer. These three methods are important, and at a high level you need to understand the pros and cons. Buying in the open market gives flexibility in the sense that the company can buy back at a lower cost, but this will take more time. Fixed price tender offer, the cost is going to be relatively high, but time is going to be quick. With a Dutch auction, it is a little bit like a fixed price tender offer in the sense that this can also be accomplished quickly. The cost would be higher than buying in the open market, but lower than the price associated with a fixed price tender offer. And finally, a company can also repurchase by direct negotiation. This is usually with a large shareholder. A company might go to the large shareholder and say that the current share price is 30. the company might pay them a higher amount, let's say $32, to buy back shares from this group. But the slight problem with this method is that company money is being used and wealth is being transferred from average shareholders to the larger shareholder. Now I want you to do example 5 from the curriculum. Let us consider the financial statement effects of repurchases. Share repurchases decrease assets and equity. If share repurchase is financed with cash, what is the impact on these ratios? As we've discussed in an earlier segment on cash dividends, the liquidity ratio comes down. Liquidity ratio is current assets over current liabilities. Whether a company does a share repurchase or if a company pays out a cash dividend, the cash comes down, so current assets down, current liabilities don't change, so the liquidity ratio will come down. The debt to asset ratio and the debt to equity ratio will go up because our debt stays the same, but our asset value or our equity value actually comes down. So the overall ratio is up, which is a negative. Coming now to earnings per share. So earnings divided by number of shares. With a share repurchase, the number of shares outstanding comes down. So you might think that this overall earnings per share number will go up. But we also need to consider what happens to earnings. If a company is using its own money to buy back shares, then the interest that the company was earning on that money is going to go down, which means that the earnings will also come down. When we consider both these impacts, then it is not obvious what will happen to earnings per share. Therefore, let's look at this ratio in a little more detail. The first scenario we'll consider is where the repurchase is with the company's own funds, and on the next slide we'll see what happens if a company repurchases using borrowed money. To figure out what happens to EPS, we should compare the company's earnings yield with the after-tax yield on company funds. Earnings yield is the reciprocal of the price-earnings ratio. It is the earnings divided by the price. If a company has a share price of 100 and the earnings are equal to 10, then the earnings yield is 10%, 10 over 100. This means that when one buys a share for 100, he is getting a $10 earnings number on a per share basis. So this number has to be compared with the after-tax yield on company funds. If the after-tax yield on company funds, this is the money that a company makes on its funds. If this number is 5%, then the EPS is actually going to go up. So if the earnings yield is greater than this rate, the after-tax yield on funds, then the EPS will go up. On the other hand, if the earnings yield is less than the after-tax yield on company funds, then the EPS number will go down. Let us also look at this through an example. A company has 1 million shares outstanding and the net income is 10 million. Share price is 20. Cash not needed for business operations is 5 million, and this money is invested and the return is 4% on an after-tax basis. What is the impact on the EPS if the 5 million is used to buy back shares? Now I want you to do this on your own before you look at the solution. Here is one way you can do this. Before the buyback, the earnings per share equals 10 because earnings are 10 million divided by 1 million shares. So earnings per share equals 10. After the buyback, our earnings will come down because this interest that we would receive, 4% of 5 million, which is equal to, after the buyback, the earnings will go down, 10 minus 0.2 million. The 0.2 million is the interest that the company will lose. 5 million multiplied by the return of 4% or 0.04. 5 into 0.04 is 0.2 million. This means that the earnings will come down from 10 million to 9.8 million. The number of shares also comes down, but by a much larger amount. When a company uses 5 million to buy back shares at $20 per share, it will buy back 0.25 million shares. In other words, we will be left with 0.75 million shares. If we do the calculation, we come up with a new earnings per share number of approximately 13. So notice that the EPS goes up. If the question simply asked whether the EPS will go up or down, you can use this technique that I showed you earlier. What is the earnings yield over here? The earnings yield before the buyback is the earnings amount, which is the EPS of 10 divided by the share price of 20. This is a fairly high earnings yield of 0.5 or 50%, which is much larger than the return of 4%. Therefore, we can just look at these numbers and say that a buyback will result in the earnings per share number going up. Let us look at another situation now where a company repurchases shares with borrowed funds. Here we need to compare the earnings yield with the after-tax yield on borrowed funds. In other words, is the earnings yield more, or is the cost that we are paying to borrow more? If the earnings yield, which again is earnings divided by price, if this is greater than the after-tax yield on borrowed funds, this is the amount that we are paying. Let's just call that R. If the earnings yield is greater, then EPS will go up. On the other hand, if the earnings yield is lower than the cost of borrowed funds, then the EPS will go down. Let's look at an example. A company has 1 million shares outstanding and the net income is 2 million. Share price is 20. The company borrows 5 million at an after-tax rate of 12% in order to buy back shares. What is the impact on EPS? In this situation, we have the earnings per share going down. Before the buyback, we had earnings of 2 million, number of shares 1 million, so earnings per share $2. After the buyback, our earnings will go down because we need to pay interest on the borrowed money. If we borrow 5 million at 12%, the interest payment is 0.6 million. Our earnings number will be 2 minus 0.6 million. The number of shares also goes down. Initially, we have 1 million shares. If we use the 5 million to buy back shares at $20 a share, that means we buy back 0.25 million shares. If we do this calculation, we come up with a EPS number of 1.9. So notice that the number is coming down from $2 per share to $1.9 per share. We can also use the strategy that I showed you up here. If we compare the earnings yield with the cost of borrowing is 12%. What is the earnings yield? The earnings yield here is 2 divided by 20, which is 10%. The earnings yield is less than the cost of borrowing, which means that EPS comes down. That is this situation over here. Next, we look at the effect of share repurchase on book value per share. And we will understand this through an example. We have two companies, X and Y, both buy back 200,000 shares. What is the impact on book value per share? And remember, book value is the book value of assets minus the book value of liabilities, which is essentially the book value of equity. And on a per share basis means that we take that book value of equity and divide by the number of shares outstanding. If we have this situation where company X has 1 million shares outstanding and the price is 20 per share, the book value of equity is 10 million. What is the impact of this buyback? Here is what you need to do. Before the repurchase, the book value per share is 10. That is simply equal to 10 million, which is the total book value of equity, divided by 1 million shares. So book value per share is 10. After the repurchase, the number comes down to 7.5. Notice that the value of equity comes down to 6 million. That's because the company is buying back 200,000 shares at $20 per share. That means the company is spending 4 million. Cash is going down by 4 million, which means equity is going down by 4 million. So the new value of equity is 6. The number of shares outstanding goes down from 1 million to 0.8 million because 200,000 shares or 0.2 million shares are being bought back. Company Y, 1 million shares, each share trading at $20, but the book value of equity here is 30 million. The book value per share is 30, which is this 30 million divided by 1 million. After the repurchase, the book value per share is actually going up for company Y. If you look at the numerator, the book value changes to 26. As we discussed over here, the amount of cash used is 4 million, which means equity comes down by 4 million. So the new book value of equity is 26 divided by 0.8 million shares outstanding. That gives us 32.5. The short method of doing this is given right here. If the stock price is greater than the original book value per share, then the book value per share comes down. In our situation here, the stock price was 20. This is for company X. And the original book value per share was 10. 20 is greater than 10, which means that the book value per share is coming down. Intuitively, you can think of this as follows. When a company is buying back shares, it is buying back expensive shares relative to the book value. And when the company does something that is expensive, that is bad, and that is causing the book value per share to come down. On the other hand, if the stock price is less than the original book value per share, that's good because the company is buying back cheap shares. Buying at a low cost is a good thing, and the book value per share in this scenario goes up. This concept is also covered in example 8 in the curriculum. The final concept we'll talk about in this reading is the valuation equivalence of cash dividends and share repurchases. And the best way to understand this is through an example. Company X has 1 million shares outstanding and the current market value is $10 per share. The company recently sold a business unit for 2 million and wants to give this money to shareholders. There are two strategies which are being evaluated. One is to pay an extra dividend. The other strategy is to repurchase. What is the impact on shareholder wealth of using each method? Let's consider the cash dividend situation first. Before the dividend is paid out, a shareholder, let's say, has one share worth $10. That's given right here. When the company sells the business for 2 million and wants to give the money to shareholders as a cash dividend, on each share the amount given will be $2. That's 2 million divided by 1 million. If a company pays out $2 per share, then the share price will fall from 10 to 8. So the share that the investor has or the owner has is worth 8, but the owner also gets $2 in cash. So the overall wealth of the owner stays the same. It's just that the wealth is now in the form of a share worth $8 and cash worth $2. Overall wealth is still $10. What about a share repurchase? Before the share repurchase, we have each share worth $10 and we have 1 million shares. After the repurchase, there are two situations. Either an investor will get $10 in cash. This is the investor or the owner who actually participates in this repurchase. He will sell his share to the company for $10 and hence has $10 in cash. What about the owners who do not sell their shares? Let's look at the value per share, and the way we calculate that is as follows. The value of the company will come down from 10 million to 8 million because the company is giving out or buying back shares worth 2 million. This money is going to the shareholders. The value of the company comes down by that amount, so it comes down from 10 million to 8 million. The number of shares outstanding also comes down from 1 million to 0.8 million because 0.2 million shares are being bought back. Where is the 0.2 million coming from? The company is buying back shares worth 2 million and each share is $10 per share. Therefore, the company is buying back 0.2 million shares and the number of shares outstanding after this transaction would be 0.8 million. On a per share basis, the value will be 8 million divided by 0.8 million, which is $10. In other words, investors who do not participate in this share repurchase transaction will be left with shares that are worth $10. Again, notice the equivalence. The wealth of an investor is still $10. Before the repurchase, wealth was 10. After the repurchase, the wealth is 10, either in the form of cash for those who sold their shares back to the company, and the wealth is 10 because the share price is 10 for the shareholders who have not sold their shares back to the company. This concept is explained in example 9 in the curriculum, so try that now. As I mentioned earlier, I am skipping section 5, concluding remarks, because that's not mentioned in the learning objectives. It is a very short section, so if you want, you can read it. But here now is a summary of the main points. You need to understand the types of dividends. At a high level, we have either cash dividends or stock dividends. With stock dividends, we can have stock dividends or splits. These are non-cash. With cash dividends, we talked about 3 categories: a regular dividend, irregular dividend, and a liquidating dividend. Then we talked about payment chronology. A company announces that it's paying a dividend. That's called the declaration date. Then we have the ex-dividend date, which is the first date where the share trades without the dividend. Then we have the holder of record date, which is typically 2 days after, and then the payment date. We talked about share repurchases, where a company buys back shares, and we talked about the financial statement effects. In general, the liquidity ratios and solvency ratios are negatively impacted, both with share repurchases as well as with cash dividends. We talked about EPS. The impact on EPS of a share repurchase depends on the earnings yield relative to either the cost of raising money when you are borrowing money or the return that a company gets on its cash. And book value per share, again, whether or not book value per share goes up with the repurchase depends on the book value per share relative to the stock price. And finally, we talked about the fact that economically, cash dividends and share repurchases are equivalent. In other words, the wealth of a shareholder is not impacted by these transactions. As always, read the summary, review the learning objectives, do all the examples. They are good in this reading. Do the practice problems and do practice questions from other sources as well.